Good afternoon and welcome to CanadianAgMarkets.com. My name is Brian Como. Today is October the 28th. Today we're going to talk about whether or not the grain market rally is sputtering and whether there is some upside still to come as a result of the Trump and Yi meeting coming later this week. Let's take a look at what happened in markets today. We saw canola up we saw canola up $4.80 to 638.80. Minneapolis wheat was up 1.5 cents at 561.75. Kansas wheat was up a nickel and three quarter to 520. Chicago wheat up 3 to 529. Soybeans were up 10 and a quarter today. They were up higher during the day session at some points. Finished off at 10.95.25, just under the $11 mark. Corn up 3 and a quarter at 432. Bean oil was down half a cent at 50.26. Canadian dollar was up almost a quarter of a cent today at 71.71. We do have both Fed and Bank of Canada meetings tomorrow, so that might create some volatility in the FX markets. Cattle was down, live cattle was down 60 cents per hundredweight to 226.58, but feeder cattle continue their descent down 9.55 today, down on the board at 324.88. Okay, we're going to start looking at charts here for beans today. As you can see, beans shot up past 11 cents or $11 a bushel today on the futures. Again, I'm looking at January at this point, almost reaching up to 11.10. Very good day for soybeans. This is still trading on the optimism for the Trump and Yi meetings. I do want to kind of take a little bit of a look here at some weekly nearby, just a longer term perspective on the charts here, because we've now bested some of these previous highs. We've moved above a lot of resistance levels, and it just continues to go higher. I think that there's still, pending a really good discussion between Trump and Xi Jinping later this week. I think there still is some upside potential in soybeans. I think it faded a little bit out today. It kind of sputtered out at some points during the session and closed quite a bit lower than its highs. And I think that's just because the market is kind of balancing risk and reward now. It looks like it's pricing in at least the optimism ahead of the meetings. Whether or not that means that I don't think that the full extent of a positive meeting is built into the markets yet. I still think there's upside to come, particularly if China issues some sales or make some purchases from US. I think that could still catapult this market higher and maybe even get up closer to this resistance level. Again, that's around 1250 to 1265, somewhere in that range. That's the previous high from May of 2024. So, more than a year ago is when these highs were put in. So just some context there. Let's look also at January canola here. We didn't see the same kind of gains in canola. It's been a little bit more of a dog. I'll show you why in just a second here, but we did test the 50-day moving average today. We've been above the 20-day moving average for more than a week now. It did test that 50-day today, was not able to close above that level. But, this is largely due to the kind of the sideways nature of bean oil. Bean oil was down today, and canola does trade quite a bit off of the bean oil price, with about 45%, let's call it, of the soybean crush being oil revenue or oil content. Versus soybeans, which is more like 18 to 20%. So canola is much more correlated to soybean oil in some cases than it is to soybeans, but we are still seeing some gains here on the gains in soybeans. I want to talk a little bit about crush margins here. Here's the soybean oil share. It has dropped to 45. It's spent, that's percent of the soybean, the cost of the price of the soybean versus the oil. It did spike up to over 50% earlier, like in the summertime. It spent a lot of time between 47.5 and 48, has now dropped to 45. This is because the soybean market is rallying, but the products are not rallying to the same degree, particularly, as we mentioned, soybean oil. But soybean meal does continue to show strength. We are now over $300 a short ton on December soybean meal. So that is helping kind of push or keep soybeans elevated, or perhaps the U.S. does export some soybean meal to the U.S. So that is, part of the reason why we're seeing this happen and why the soybeans are rallying so much is because the value of the products is also rallying as a whole. Let's look at the board crush, though. It is getting a little bit less profitable here for board crush. This is 6 months of board crush. As you can see, we saw some really high margins in June, July, and August, which supports the crush business. Down at 142 here, there may not be as much of an incentive. Let's look at board crush, though, because that's still up near recent highs. It's above 200. We still think that is excellent. Board crush margins for canola. There are likely processors that are hedging this so that they can process the grain later on at these high margins. Of course, this is only factors in the futures value, so the basis value, both at the farm gate and at the on the vessel, would have an impact on these cash margins. But this is a good indication that margins as a whole are still healthy above 200. That still, in our minds, is incentivizing deferred crush to occur. All right, let's turn to the wheat markets here. I'm going to show spring wheat first. It was the most subdued of the bunch. Again, we said there was only up about 1.5 cents, if my memory serving me correctly there. We did see a test of that 50-day moving average, did not pierce that level. We do have some resistance just under 580 here on the December chart, and then at 605-ish or so on the December chart as well. We did issue some guidance to our full subscribing customers today, talking about levels where you could put some target prices and things like that. So if you're not a subscriber already, go to canadianagmarkets.com/subscribe and get all of our news features there. Let's look a little bit at HRW wheat. We did see some good follow through there. We are now kind of pushing up towards the 100-day moving average. We've seen some good gains here on HRW wheat. That does lead me to kind of look at the December less Kansas City wheat spread as well. As you can see, through much of the summer and fall, or you could say that once the MIAX took over the Minneapolis wheat contract, we've seen relatively steady spreads between 55 and call it 70 or 65, even if you take these big peaks out. That now has dropped to 41 and 3/4. So we are seeing a bit of a degradation in the premium of the hard red spring wheat to the hard red winter wheat overall. So I think that's just because those wheat markets are a little bit more liquid. Folks who are looking to play the Trump trade or the China-U.S. trade agreement are probably using Chicago and Kansas more, and leaving Minneapolis out due to some lower volumes and just liquidity issues in general in that contract at this point. Here is Chicago. Similar story here. We saw Chicago rally up into the highs that we saw in mid-September, challenging kind of that 100-day moving average. We still think there is some upside in wheat if the rest of the complex continues to rally. We think that wheat is kind of one of those a rising tide raises all boats kind of situation. So wheat is kind of on the backs of some of the other markets that are optimistic because of the U.S.-China trade deal. Or the potential U.S.-China trade deal. That goes for corn as well. As you can see, corn actually tested the 200-day moving average today before fading. So these markets are kind of sputtering out a little bit. Again, I think that is just some positioning before the meetings later on this week. And you don't want to put too much risk on the table in case something goes wrong. So they might be paring back a little bit of risk there, or maybe even taking some profits prior to that meeting. Maybe some traders are thinking that it's good to sell the rumor at this point instead of selling the fact later on. So that is what our grain markets look like. Let's look at cattle markets here. So, again, we've been talking about this for a while. Cattle markets react to policy uncertainty on beef and cattle imports. Trump made some comments about lowering the price of beef to consumers, and there are lower cattle imports coming from places like Mexico and Brazil, et cetera. So the cattle markets are still in what could be described as a bit of a free fall. January feeder cattle are taking the worst of it, traded down close to $320 a hundredweight on the January. We've seen a number of gaps in this market. So, we are kind of in A pretty strong bear market correction here. We moved below these previous September lows as well. So that opens this market up to tests down into the 290 range. So just wanted to be cognizant of that. The live cattle isn't quite as aggressive on the sell side, but we still are seeing that previous low broken, and we are seeing the 100-day moving average get broken, and basically a full day of trading below that 100-day moving average. So this still looks negative as well, but this market was pretty heated up coming into October and into the middle of October. So, we're seeing a big sizable correction here as a result of just some fears in the marketplace. Canadian dollar has been rising. Again, we talked about it adding about a quarter percentage point today. That's the biggest move that we've seen in this kind of rally off the bottom so far. We did trade above and closed above that 200-day moving average. We moved well above the 20-day moving average as well after this cross here. This cross should have been pretty bearish, actually. So, it's kind of trading counter to what these technical indicators would suggest. But there is a bit of a risk on attitude going into the markets right now. I'll show a couple of other examples here. So they may be selling, safe haven currencies like the US dollar might be getting sold in favor of the Canadian dollar. Again, there is both a US and a Canadian interest rate announcement. Tomorrow, the Canadian one will happen first in the morning and the US one will happen in the afternoon. But we are seeing, again, a move to more risky assets. Here is kind of the S&P 500, which is a good indication of where the equity markets are headed or thinking. We made new all-time highs again today, moving up towards 7,000. This, of course, is the futures of the S&P 500. So good performance and good moves, I guess, money flows into riskier assets. You can also see this in the gold market because gold again is considered a safe haven, and we saw that run up during kind of the escalation in trade that was happening with China and the U.S. Now we are seeing that back off considerably. It moved up to about $4,400, and now we're down to about 39.70. So a big correction here in gold, which signals to us that the risk is coming out of the market, or traders are pricing in less risk in the market and are moving back to the riskier assets, which may be beneficial to the grain markets overall. All right, if you'd like to get our premium reports and morning commentaries, etc., go to canadianagmarkets.com and get all the reports that we publish on a regular basis, including ad hoc and our weekly market outlook, etc. Canadianagmarkets.com/subscribe is where you go to that. And if you're not already subscribed to this YouTube channel, it really helps us out, and we thank you very much. We will see you again tomorrow.